There's a number the government changes that you never vote on, yet it affects the price of your bread, your rent, and your retirement, and most people don't even know it exists. On a Wednesday morning in March 2020, a conference room in Washington, D.C. held 14 people around a polished oak table, none of whom had been elected by anyone. The Federal Reserve Board was meeting to decide something that would touch every wallet in America. Yet no cameras were allowed inside, and no transcript would be released for weeks. By noon, they had agreed to lower the federal funds rate to near zero, a decision announced in a single paragraph that most Americans scrolled past while checking their phones. What they didn't announce was what would happen next, a flood of money into the economy so large it would make the 2008 financial crisis response look modest. Within months, the Fed had purchased over $2 trillion in government bonds and mortgage-backed securities, essentially creating money from nothing and injecting it into the financial system. Sarah Chen, a 28-year-old teacher in Austin, noticed something strange in July of that year. Her grocery bill had jumped from $92 to $118 for the exact same items. She checked her receipt 3 times, convinced the cashier had made an error, but every item was correct. Milk had gone from $3.50 to $4.20, eggs from $2 to $3.15. Sarah assumed it was temporary, maybe a supply chain hiccup from the pandemic, and adjusted her budget by cutting back on the coffee she loved. What she didn't know was that the money the Fed had created was working its way through the economy like water through a dam with a crack, slow at first, then all at once. By the end of 2021, the money supply in the United States had increased by 40%, the fastest expansion since the government started keeping records in 1960. If you found this video useful, please consider subscribing, liking, sharing, and leaving a comment. It helps the channel grow and allows us to continue producing documentary-style content like this. The Federal Reserve doesn't actually print money the way most people imagine. There are no printing presses running overtime, no warehouses filling with fresh bills. Instead, the Fed creates money digitally by crediting banks' accounts, a process so abstract it sounds almost magical, yet it's as real as any dollar in your wallet. When the Fed wants to inject money into the economy, it buys assets from banks, usually government bonds, and pays for them by adding numbers to the bank's digital reserve accounts. Those banks then have more reserves, which they can lend out to businesses and individuals, multiplying the effect through what economists call the money multiplier. This system was designed in 1913, refined during the Great Depression, and has operated under the assumption that the people running it would exercise restraint. But restraint is hard when the economy is collapsing, unemployment is spiking, and politicians are demanding action. The Fed's mandate is to prevent economic catastrophe, not to worry about what happens 5 years later. In March 2020, with businesses closing and markets crashing, the Fed faced a choice: do too little and risk a depression, or do too much and risk inflation. They chose too much. And they weren't alone. Central banks in Europe, Japan, and the United Kingdom made the same decision within days of each other. The problem with creating money is that it doesn't create wealth, it just redistributes it in ways that aren't immediately obvious. When you double the money supply but don't double the goods and services available, each dollar becomes worth less, like watering down orange juice until it barely tastes like oranges. Economists call this inflation, but that word doesn't capture what it feels like to watch your savings lose value, or to realize the raise you got doesn't actually let you buy more. By late 2021, inflation in the United States had reached 7%, the highest rate in 40 years, and people started to notice. Marcus Rodriguez owned a small construction company in Phoenix, and in January 2022, his lumber supplier called to say prices were up 30% from the previous year. Marcus had fixed-price contracts with 3 clients, which meant he would lose money on every project unless he renegotiated, but his clients were already stretched thin. He raised his prices anyway, by 25%, and one client walked away saying they'd wait until costs came down. That client was Emily Tran, who had saved for 6 years to renovate her kitchen, but her $70,000 budget was suddenly only enough for half the work. Emily decided to wait, which meant Marcus lost the project, which meant he had to lay off 2 workers, which meant those workers cut their spending, which meant other businesses felt the pinch. This is how inflation spreads, not as a single wave, but as 1,000 ripples that intersect and amplify, touching people who never heard of the Federal Reserve's decisions. Rent followed next. Landlords saw their costs rising for maintenance, insurance, and property taxes, and they passed those costs to tenants.
In Austin, Sarah, the teacher, saw her rent increase from $1,400 to $1,800 when her lease renewed in March 2022, eating up the entire raise she'd received that year.
She considered moving, but everywhere she looked had similar increases. The whole city had shifted, not just her building. What confused Sarah was that everyone told her the economy was strong. Unemployment was low, the stock market had recovered, and wages were technically growing. But that analysis missed a crucial detail. Wages were growing at 5%, while prices were growing at 8%, which meant everyone was getting poorer in real terms. The people hurt most were those who couldn't negotiate higher wages: retirees on fixed incomes, service workers without union protection, savers who kept their money in banks earning near zero interest. By mid-2022, the Federal Reserve finally acknowledged they had a problem and began raising interest rates to slow the economy down and bring inflation under control. But the damage was done. Prices that had risen didn't come back down. They just stopped rising as fast, which meant the new normal was permanently more expensive. 3 years after that March meeting, Sarah sits at her kitchen table, calculating whether she can afford to keep teaching or if she needs to find a second job. Her salary has increased by 12% since 2020, which sounds significant until you realize her rent is up 28%, groceries up 35%, and car insurance up 42%. The math is simple, but brutal. She's working the same hours, doing the same job, yet her standard of living has declined. Marcus, the contractor, survived by pivoting to smaller projects and cutting his own salary, but he's 49 now, and his retirement account, measured in real purchasing power, is worth less than it was 5 years ago. He calculates he'll need to work until 68, maybe 70, not because he didn't save, but because the value of what he saved evaporated. These aren't abstract statistics. They're the cumulative weight of a policy decision made by 14 people in a room, broadcast in a paragraph, implemented through digital ledgers that most Americans never see. The Federal Reserve will tell you they prevented a depression, that without their intervention, unemployment would have soared and businesses would have collapsed by the thousands. They're probably right, but that doesn't change the fact that their solution created a different kind of pain, slower, quieter, harder to measure, but no less real. What makes this particularly difficult is that there's no villain to blame, no single decision that was obviously wrong, just a system designed to respond to crises that creates new problems while solving old ones. The machinery of monetary policy operates on time frames that don't match human lives. The Fed thinks in quarters and years, but Sarah needs to pay rent next month. And here's what keeps economists awake at night. The next time a crisis hits, the Fed will face the same choice again, and the tools they have, interest rates and money creation, carry the same trade-offs they always have. You can design better policies, refine the models, adjust the timing, but you can't escape the fundamental tension. Money created from nothing eventually costs something, and someone always pays.
Sarah doesn't think about the Federal Reserve when she's buying groceries or signing her lease. She's too busy living with the consequences of decisions made in rooms she'll never enter.
The number they changed, the one you never voted on, is still there, still being adjusted, still shaping your world in ways that won't show up in headlines until it's already too late to matter.